Since 2022, there's been a massive shift in how global oil flows. A new energy relationship has popped up that's as controversial as it is consequential. It's become a cornerstone of a new economic order. But what would happen if it just, poof, vanished? Okay, let's dive into this.
We're going to explore the global aftershock of this one single massive hypothetical. What if India, one of the world's biggest energy consumers, just decided to turn off the tap to Russian crude? The ripple effects would be felt, well, pretty much everywhere.
So first things first, to really understand the impact, you have to grasp the sheer scale of the change that's already happened. This India-Russia oil trade, it's not some minor adjustment. It's a fundamental rewiring of the entire energy map. Before the war in Ukraine, Russia was barely a blip on the radar for India's energy needs. Seriously, its share of India's total oil imports was less than 1%. It was a footnote, really.
And today, wow, it is a completely different story. Russian crude now makes up around 40% of India's total oil imports. Think about that jump, from almost nothing to being the #1 supplier in just a couple of years. It's incredible.
And this chart just lays it all out. Look at that bar for Russia. It completely dwarfs India's traditional suppliers, like Iraq and Saudi Arabia. We're talking about a flow of over 1.7 million barrels every single day.
So you might be wondering, how much is India actually saving with all this? Well, that is a huge point of debate. On one side, you've got an analysis from CLSA that pegs the net gain at a pretty modest $2.5 billion. They argue that things like shipping and insurance costs eat up most of the discount. But on the other hand, a lot of folks in the industry say it's an absolute windfall, maybe over $17 billion, especially when you think about how India's buying spree helped keep global prices from just exploding for everyone.
And the mechanics of how this trade actually works, it's fascinating. This isn't your standard business deal. It relies on a so-called shadow fleet of tankers to get around sanctions. Over 90% of the deals are settled in local currencies, in rupees and rubles, not US dollars. Now that created a weird problem. Russia ended up with billions of stranded rupees it couldn't really spend. So what did India's central bank do? They came up with a creative solution, a yield-bearing parking lot where Russia can invest that cash in Indian government bonds. They are literally building a whole new financial architecture on the fly.
Okay, so let's play this out. What's the first shockwave if this all stops? For India, it would trigger an immediate and frankly painful economic recalibration right at home.
It would set off an instant chain reaction. India would be forced to go back to its more expensive traditional suppliers. That makes the national import bill jump. And where does that cost go? It gets passed directly to you, to the consumer at the gas pump, which in turn fuels inflation, a real headache for any government. And we can actually put a number on that pain. The State Bank of India estimates it would add a staggering $9 billion to the country's annual import bill. That's a massive fiscal hole to suddenly have to fill.
And this quote, right here, is India's official justification. And you have to admit, it's a powerful one. The government frames this whole policy as a matter of non-negotiable national priority. You know, when you're responsible for keeping the lights on for 1.4 billion people, economic pragmatism tends to win the day.
All right, now let's flip the coin. For India, it's a big economic shock, but for Russia, losing its second largest customer would be a severe strategic and financial blow, a really big deal. This table really puts it in perspective. Take August 2025. India accounted for 3.6 billion euros of Russia's fossil fuel money. That's second only to China. Losing that kind of steady, high-volume income would directly blow a bigger hole in Russia's already strained federal budget.
So where would all that oil go? The logical answer seems to be China, right? But that's not a perfect fix for Moscow. It would mean flooding its biggest customer's market, forcing Russia to offer even steeper discounts, which just erodes their profits even more. And maybe, more importantly, it would make Russia almost completely dependent on Beijing, giving China immense leverage to call the shots.
So the shockwave wouldn't just stop with India and Russia, it would radiate outwards, slamming into the entire global energy market. We'd see a major price spike and a total redrawing of trade flows.
And this is the number that gets everyone's attention. Analysts predict that a sudden disruption of this size could send global crude prices through the roof. Some estimates go as high as $200 a barrel. Even the lower predictions of $90 to $100 would send a nasty shock through the global economy.
An event like this would also speed up a trend people are already worried about, the balkanization of the oil market. Basically, instead of one big, integrated global system, we'd start to see these separate, politically aligned trading blocs. It's an energy world broken up into different spheres of influence.
And that brings us to the final, and maybe the most significant ripple effect of all, the rebalancing of global power and the hardening of new alliances.
This trade has already created a major point of friction between the US and India. The US has tried using punitive tariffs to get India to change its mind, a move that India has flatly rejected as unjustified. It's become a direct test of India's strategic independence.
But here's the twist that gives India a lot of diplomatic cover. While the US is putting pressure on India, the European Union is still importing Russian fossil fuels itself, mostly through pipelines. So India points to this and calls it a global double standard, and that argument really weakens the pressure coming from the West.
When you zoom out, this trade is really a catalyst for a much bigger trend. By using local currencies, it becomes a real-world experiment for de-dollarization, a core goal for the BRICS nations. This isn't just about what currency you use, it's a direct attempt to build a parallel financial system, one that's insulated from U.S. economic power. And ironically, the more pressure the West applies, the more incentive these countries have to build it even faster. So in the end, maybe the best way to understand this whole complex trade is to see it as a bridge. For India, it's a pragmatic, if controversial, way to guarantee its energy security today, while it works like crazy to build out its renewable and nuclear power for tomorrow. The end goal is total energy independence by 2047. And this trade, it might just be the bridge to get there.
Which leaves us with a central question, doesn't it? Is this trade just a practical bridge helping a nation secure its future? Or is it an active catalyst helping to create a more fractured, multipolar, and maybe even more volatile new world? The truth is, it's probably both.